role, maybe sales and trading, fixed income is a very quant position. If you're interviewing at a hedge fund that's a quant hedge fund, then you're probably going to be a math person to begin with. But I think in banking, just talk about whatever your favorite subject was and why. Right? Probably shouldn't be gym class. Right? Probably should be something a little beyond that. Shouldn't be study hall. Right? But I think that's a pretty straightforward question. Any thoughts on that or questions? All right. I'm sure you can think of a lot more qualitative questions. I'm sure you've been asked a lot more qualitative questions as well. I think those are probably some of the more common ones you'll see, though. So I would say at the very least, just be prepared on those. But really be, for a banking interview, be more prepared to talk about some of the technical issues here. And again, like I said earlier, at this point we're going to talk more on the technical issues we've discussed in class. This will be kind of a course review of sorts. And as you're preparing for interviews, this can also be a really good reference back to some of these course concepts. There is also a handout that I put on the table back there for common interview questions that goes well beyond just those that we have here in the slideshow. So take a look at these, use these as a reference, but also go through that handout because there are dozens of questions in there that you can use as a guideline to help you prep for interviews as well. All right, but common questions, technical questions you'll get in banking interviews or maybe even private equity interviews. What is total enterprise value? Obviously, it's one of the key concepts of the course. We've been talking about it since class 2. All right, so it's very important. You're going to need to be able to define it, the value of the total company, the value provided by all providers of capital, debt, equity, preferred, etc. You should be able to tell someone what the formula is and why each individual item is included in that formula. So market value of equity plus debt plus preferred plus minority interest minus cash. All right, market value of equity needs to be on a fully diluted basis. I think we'll talk about that a little more later, but you should be able to note that. What's the difference between enterprise value and equity value? Again, enterprise value is the value of the total firm. Equity value is specific to only one provider of capital. All right, for a heavily leveraged firm, equity value could be a very small percentage of total value, total enterprise value. And so that's why we look at TEV. It combines all forms of capital. What is minority interest? If you own more than, it should be 50%, not 80%. If you own more than 50%, or if a company owns more than 50% of another entity, it's required to consolidate the books. Minority interest is the portion of that firm or that entity that the company does not own. If you think of it as a liability, I think that's probably the best way to remember that. How do we calculate MVE or equity value? Stock price times shares outstanding, but remember, shares outstanding needs to be on a fully diluted basis. Fully diluted means we take our basic shares and then we incorporate the effect of dilutive securities. Dilutive securities like options, warrants, convertible preferred, convertible debt. All of those things need to be taken into account. That dilution needs to be added to our basic share count. All right, basic shares always from the cover of the most recent 10K or Q, all right, whichever is more recent. Okay, should you use basic or fully diluted? We just said we should use fully diluted. The reason being, if we only use basic, we're going to undercut the valuation of the company. All right, market value of equity will be too low, and when we add that into our total enterprise value, TEV will be too low as well. So always use fully diluted shares. And the dilution is always calculated using the treasury stock method. All right. Remember, treasury stock method is where we assume that proceeds from the exercise of employee options, those proceeds are used by the company to go out in the market, buy as many shares as they can at the prevailing market price, and then only issue the difference as net new shares. All right. Any questions on these? This should all be reviewed. If something doesn't look right to you, or if you have a question, definitely let me know. Now is the time. You also get some accounting questions from time to time. All right, please name a few items from the current assets, current liabilities sections of the balance sheet. Again, this is meant to test your knowledge of accounting, meant to test your knowledge of how a financial statement is set up. All right, so on the balance sheet, current assets, cash, AR, inventory, etc. On the liability side, current liabilities would be things like AP, accrued liabilities, current portion of long-term debt, etc. Longer-term assets would be gross PP&E, right? The fixed assets of the company, buildings, machinery, equipment, vehicles, land, furniture, computers, etc. And then other long-term assets would be intangibles, goodwill, etc. The liabilities and equity side, longer-term liabilities are probably going to be long-term debt, capital leases, maybe some pension obligations. And then the equity section will be things like common stock, additional paid-in capital, retained earnings, treasury stock, etc. All right, should be pretty much review. Remember, balance sheet must balance, obviously. How is the cash flow statement structured? Remember, there are three sections of the cash flow statement: cash from operations, cash from investing, cash from financing. Cash from operations takes net income. To that, we add any non-cash charges like D&A, sometimes non-cash gains or losses, etc. Changes in working capital accounts. Investing section usually will be things like CapEx, asset dispositions, purchase or sale of long-term securities, acquisitions to the extent the company's done them. The financing section will measure changes in our capital, in our equity accounts, in our debt accounts, borrowings, repayments, issuance of new equity, repurchase of treasury shares, dividend payments, etc. All right. So be prepared to walk people through those financial statements. Be prepared to walk someone through an income statement as well. Remember when we put up the income statement down to EBIT, everything EBIT and above was operating related? Be prepared to make that distinction, operations versus financing down here. All right. Questions on this? Another accounting question: how is depreciation integrated within the three financial statements? Remember, depreciation gets expensed in the income statement. All right, so it's a non-cash expense in the income statement. Because it's non-cash, we add it back to net income in the cash flow statement, cash from operations section. And then depreciation is also found in the cumulative depreciation section of the balance sheet. All right, so you'll see it work its way through all three financial statements. All right, questions on that? Everybody follow that? A lot of people have been getting these. I've had several students get this very question, all right, as well as a few others that I'll point out later on. What are the typical valuation multiples? We've gone through these. We've got our enterprise value multiples, enterprise value to revenues, EBITDA, EBIT. Remember, it needs to be operating to operating, unlevered to unlevered. Enterprise value is unlevered. It does not consider specific capital contributions, does not consider leverage. We're blind to how the company is financed. And then those denominator items are all EBIT and above in the income statement. They're all operating related. And then price earnings is an equity multiple. It is after we've taken into account the amount of debt the company uses. All right, market value of equity is specific to the equity holders. After we've considered debt, earnings is earnings available to the common shareholders after interest expense has been paid. All right, so you've got unlevered multiples here, and price earnings is an equity or a levered valuation multiple. You never want to be apples to oranges. You don't want to be saying total enterprise value to earnings. You don't want to be saying price to sales or price to EBITDA. All right, operating to operating, equity to equity. All right, M&A question: if a company with a high PE ratio acquires a company with a low PE ratio in a stock deal, assuming everything else constant, will it be accretive or dilutive? It's the opposite of what we saw yesterday. It would be an accretive deal. All right, the company buying and issuing stock, their stock is highly valued, it's valuable currency. They have to issue proportionately less of it for every dollar of earnings they acquire. In this case, the numerator, earnings, is rising faster than the denominator, shares outstanding. All right, that would be an accretive deal. Yesterday was the exact opposite. That Kraft-Kellogg deal was dilutive. You had a low PE buying a high PE in a stock deal. Everyone understand that one? How do you value a company? Basic valuation question. You need to be able to tell people at least these three valuation methodologies: DCF, comps, and precedent transactions. All right, you also should be able to tell someone that trading multiples will give you a minority interest-based valuation. Precedent transactions and DCF will be controlling interest valuations, like we talked about. And everybody should be clear on those as well. Describe each valuation methodology, right? DCF, we're forecasting future cash flows, discounting them back to the present, using time value of money, using a discount rate. We'll talk more about the discount rate in a moment. Trading multiples, we're using the stock prices of minority positions in publicly traded comparables. We're using those valuation multiples implied by that analysis to value our company on a minority basis. Precedent transactions, we're looking at actual acquisitions involving controlling interest positions of similar target companies. All right, so again, precedent transactions includes a control premium, so it's on a controlling interest basis. It's the main difference between precedent and trading multiples. Again, same thing. Precedent multiples should be higher because it includes the control premium. In order to induce the selling shareholders to sell, we have to offer them a little bit more. Describe the DCF model in layman's terms, and you will get these definitely if you go into a banking interview. They need to understand, they need to know that you understand these things. So you should be able to walk someone through a DCF. I know it includes a lot of steps, but you do need to be able to describe it. So again, a DCF will project future free cash flows out into the future, usually for a 5-year period. Those will be discounted using a weighted average cost of capital back to the present. All right. DCF will then calculate the terminal value of the company at the end of the forecast period. In a 5-year model, that would be years 6 and beyond. We would calculate that using an EBITDA multiple approach. We would then discount that back to the present as well. And we would add the present value of our free cash flows for that 5 years plus the present value of the terminal value to get the overall value of the company on an enterprise value basis. All right. And DCF, if you're using a weighted average cost of capital approach, will give you total enterprise value as the result. Remember, weighted average cost of capital includes all sources of capital. If you wanted to do an equity value approach, you could then subtract debt, get down to subtract debt, add back cash, subtract minority interest, subtract preferred, get down to equity. All right. How do you calculate free cash flow? All right, again, this is an indication of total enterprise value, so we're going to start with EBIT, which is an unlevered operating metric. We'll take out taxes. We'll have to fund our working capital changes. We'll have to fund our CapEx. We'll add back D&A because it's non-cash. And that's our free cash flows. That's what gets discounted back, right? How do you calculate terminal value using the Gordon growth approach? It's just a terminal value multiple. If you've ever taken a finance class, this is probably what you've seen. We didn't spend a lot of time on this in class, but terminal value is calculated by growing free cash flows in year 5 by 1 plus the growth rate. You then discount that by cost of equity minus the growth rate. The one thing I would note here, if you're going to use a Gordon growth approach, be real careful what that long-term growth rate is. It should really never exceed inflation. Otherwise, you're implicitly assuming that the company eventually becomes the entire economy. Remember, this goes into infinity. Right? How do you calculate terminal value using the multiple approach? It's just we take our terminal year EBITDA, so year 5 EBITDA, multiply it by an assumed EBITDA multiple. And a lot of times that assumed EBITDA multiple comes from our comps, comes from other analyses that we've done, showing what that would be at the, what it is today. A lot of times we would assume that that multiple will stay relatively constant and still apply at the end of year 5. How do you determine the discount rate to be used in the DCF? Again, it's WACC, weighted average cost of capital. What is WACC? How do you calculate it? All right, WACC, again, weighted average cost of capital. We are weighting cost of our equity times the relative proportion of equity to the total capitalization. We weight our debt by its weighting in the capital structure. We multiply our cost of debt times 1 minus the tax rate because interest is tax deductible. Cost of debt should always be looked at on an after-tax basis. How do we calculate cost of equity? Using CAPM, the capital asset pricing model. You will get this one a lot, right? This is a very, very common question. What is CAPM? How do you calculate it? It's our risk-free rate. Risk-free rate's usually a government security, 20-year T-bond, something like that, 20-year treasury. To that, we add beta times the market risk premium. All right, market risk premium represents the excess return over and above the risk-free rate that we might expect if we hold equities as opposed to U.S. treasuries. All right, the flaws in the CAPM model, number one, beta, shown not to be an accurate predictor of stock price movements. Market risk premium can vary widely depending on what periods you use, also not necessarily an accurate predictor of future stock price returns. All right. Remember, everything from CAPM is generally looked up. There are ways you can calculate beta, but generally speaking, you're going to look those up, maybe from Bloomberg, maybe from Zacks, maybe from some other financial data source. And typically, you're going to use a 5-year beta. Where does the market risk premium come from? Who can tell me? Ibbotson, exactly. Ibbotson and Associates publishes stocks, bond, bills quarterly. It's typically looked up from that publication. Typically, we use a long-term equity risk premium. Any questions on that? What is beta in layman's terms? Again, beta measures volatility of a stock relative to an underlying index. It's a measure of quote-unquote systematic risk, risk that we could diversify away if we took a portfolio approach to managing investments. So if a company has a beta of 2, it means it's going to be twice as volatile as the market. A company with a beta of 1 will be as volatile as the market. A company with a beta of 0.5 would be half as volatile as the market. Right? What's more expensive, equity or debt? Equity, right? Because it's the lowest seniority in the capital structure. If a company goes bankrupt, usually the equity of the company is worth nothing. Usually a lot of times some of the debt ends up being heavily discounted in terms of what they're able to recoup. And secondly, there's no obligations for dividends to be paid. Right? Equity is also paid after debt in the income statement. It comes after interest expense. Right? Which of the following has the lowest rate? Secured debt, secured bank debt, sub-debt, preferred equity, and equity. It's actually in this order. Secured bank debt will be the lowest. It's secured, it comes first in a liquidation, it gets paid first, it gets paid before equity in our income statement. All right, then sub-debt, preferred stock, and then common stock. Cost would get higher as we go down the line for those 4 items. Make sense? Any questions so far? I know I'm going kind of fast. It should be review, right? But if there are questions, please ask. What's PIK? Remember, PIK stands for pay in kind, payment in kind. Means that